Greetings from the overflow room. My name is Glenn Tung. I'm a shareholder from New York. This is my 20th Berkshire annual meeting, and I'm delighted that we're able to once again be here in person. You two have brought tremendous joy to all of us through the years, and speaking personally, your wisdom has not only made me a better investor, but more importantly, a better, happier person. It's a privilege and honor to thank you. So Warren and Charlie, thank you.
Well, that's my kind of a question.
Yeah, that's fine.
Let's have more of those.
Yeah. Or you can say it again. I mean,
Maybe you could sing it.
Maybe I should quit at this point.
Glenn, go to it.
My question relates to share repurchases. Since you started buying back Berkshire shares in size 2 years ago, the repurchases have ranged between $1 billion and $3 billion per month. By my estimate, it appears that the buyback rate is about $3 billion per month, when Berkshire's trading at a 20 or so % discount to intrinsic value, $2 billion per month at about a 10% discount, and $1 billion per month at a 0 to 10% value. Do I have that about right and approximately right? And do any other factors influence the rate of share repurchases?
Well, after you were so nice in your introduction, I have to say that yeah, you're actually wrong in our. If somebody had offered us $50 billion worth of stock at a certain point in the last 3 or 4, 5 months, we'd have taken it. You know, it's that simple. And as I mentioned earlier, we haven't bought any stock in April. It's something that when we can do it, and we know, at least we think the probabilities are very high. We certainly believe it in terms of our own evaluation and our own investment. If we think that we're improving things for the remaining shareholder, we'll buy it back. And if we don't buy it back. And if we have the choice of buying businesses that we like or buying back stock, controlling factors how much money we have, we'd rather buy businesses. And so it isn't, you know, we don't stay awake at night working out formulas or anything of the sort. But we don't ever do it if we think that we're not doing something at the time. If we had a lemonade stand and Charlie and I and you owned it, and the lemonade stand was making us about $1 a week or something, and we divided it up, and you said you wanted to get out, and if you said one number, we'd have the funds in our little lemonade company, and we'd buy you out, and if we didn't like the price, we wouldn't buy you out. It's the same way we feel. But we do feel an obligation to do things that we think are intelligent and in no way risk, absolutely no way present any risk of financial problems under any circumstances we can envision, except maybe something like nuclear war. You know, we'll do it, but it never can be that big a factor. Certain companies, well, Charlie, I think spoke the other day, actually with Henry Singleton. I think he bought back 89% of the company over time. And he sold stock like crazy, or issued it much earlier when it was overpriced. And he bought it back underpriced. But the key to that, of course, is having people think you're wrong in doing it. So he was able to buy a ton of it. And there's some other companies that have bought a ton of it. Berkshire isn't going to get the chance to do that because if people think we're buying, we've got sensible shareholders, is what it amounts to. If we had the same group of shareholders that own 2-day puts and they were our shareholders, we'd buy back the whole company, you know, in a very short period of time. But it's such an easy concept to assess. I mean, the second stock I bought City Service Preferred. That was the first one. Second stock I bought was a company called Texas Pacific Land Trust. And that came out of the bankruptcy of the Texas and Pacific Railroad back in the 1880s or something like that. And they had 3 million some acres, and they owned the minerals, and they owned the surface and everything else. But it was terrible land in the 1880s. But they had some kind of a charter that said to use the proceeds from land sales. Whatever it was, they were going to buy in stock every year. And you know, I sat there when I was 13 or 14, and I figured if I lived to be 100, I would own the whole place. Well, I haven't lived to be 100 yet, and I wouldn't have bought the whole place. So both calculations are so far imperfect, but it's been a remarkable company. I mean, just plain remarkable, because they would talk about grazing fees of $6,000 a year or something like that, maybe when they had 3 million acres. And then they kept finding oil and more oil and more oil, and they've changed the form and all kinds of things, but they bought in stock week after week after week. And I sat there and figured out how long it would take until I owned the whole company. And I obviously made some improper calculations because it wouldn't have worked that way. But it still was apparent to me that it would be a very good idea if they had 3 million acres down there, that if they got all through with it and they kept their mineral rights and all kinds of things, which they were doing, it ought to, at a very cheap price, it ought to work out well for anybody who sat around for a long time. And it has worked out extremely well for anybody who sat around a long time. But nobody knew that they were going to find a lot of oil, and that eventually El Paso would grow out far enough so that the surface lands became worth some money, that they were somewhat near El Paso. Then you had to go a couple of hundred more miles to find the next person, but that was another problem. So it's just so, some of the stuff is so simple, but people want to get their PhD or something, so they work out hundreds of pages and have lots of Greek letters in it and all that sort of thing. And either you're buying out your partner at an attractive price, or you're not buying them out at an attractive price. And if you got the money around to do it and the price is attractive, you don't have some other opportunities, why not do it? I mean, you got to come out ahead by doing it. And if you've got other things that are more intelligent, you don't do it. And if it isn't intelligent on an absolute basis, you also don't do it. Charlie, have you got anything to add to what were you doing in 1943? You were in the service. And
Warren, we'd be crazy if we didn't rather enjoy having come a considerable distance from small beginnings. And to do that in good company, it's a favored life.
Yeah.
We've been very fortunate.
Yeah. And tomorrow, Monday, I can tell you it's almost certain that if anybody offers us, well, there'll be shares trade at Berkshire, and we won't buy any. But it's also a pretty fair chance someday a lot of shares, quite a few shares, not a lot. Berkshire's got our shareholders are too smart. That's one of our problems. If we want to repurchase shares. But we really don't want to squeeze it. We don't want to squeeze out anybody, but we also are here to do things that increase the value for the people who stick with us. I mean, it's not very complicated, and there'll be times when we'll do it, and there'll be times when we won't. But there won't be any formula, but there will be the principles that I've just expressed. And my guess is that my successor and their successor will have a similar calculation, because we're looking for people that are rational and devoted to Berkshire. So, Glenn, thanks for coming, and Becky, you're next.